there. Welcome to Trading Day. I'm Lindsay Biscaya. Let's get to some of the stories we're following in the BNN Bloomberg newsroom today. Shares of Denison Mines are seeing a surge. The Canadian uranium firm says it's ready to begin constructing its uranium mine in Saskatchewan once it receives final government approvals. The project is poised to begin producing uranium by mid-2028 and is set to become Canada's first major new uranium mine since Cigar Lake. Denison warns, however, that total costs for the project are now estimated to be 20% higher at more than $500 million. Shares of Ivanhoe Mines are trading higher today. The miner says a smelter at its complex in the Democratic Republic of Congo produced its first copper anodes. Ivanhoe says the smelter's ramp up to 500,000 tons of copper will be completed toward the end of this year, and shipping nearly 100% pure copper instead of concentrate will cut the project's logistics costs in half. Ivanhoe holds a 39% interest in the site, which is one of the world's biggest copper producers. And shares of furniture retailers Wayfair and RH are getting a boost today. That's after U.S. President Donald Trump pushed back a tariff increase on some imported goods. The move delays a 30% tariff on upholstered furniture and a 50% levy on kitchen cabinets and vanities. The higher tariffs were set to take effect on Thursday, but now they will take effect January of next year. Trump says the move is due to ongoing trade talks. A 25% tariff imposed in September will remain, though. And we'll take a look at the markets today. The TSX is up for the first trading day of 2026 after ending on a bit of a low note for the last day of 2025. If we look at U.S. markets today, you can see a bit of mixed trading today, mostly flat. S&P 500 down by 0.1%. The Dow Jones down by 0.1, or up by 0.1 rather, and the NASDAQ is down by 0.2% to start off the year. And we're going to turn to the latest in the markets as our next guest tells us more about her expectations for this year. For more, we are joined by Adrienne Young, Portfolio Manager and Director of Credit Research at Franklin Templeton Canada. It's good to have you join us. Thanks so much, and Happy New Year.
Happy New Year to you, Lindsay.
Thank you. Your expertise is credit, so I want to get to that in a moment. But just first of all, when we're taking a look at the markets on this first trading day of 2026, is this kind of what you're expecting to see as we start the year? And how do you think things will go? You think it's going to kind of moderate out a little bit and trading will be a bit more moderate this year?
I think we are going to see a little moderation, yeah. 2025 was really a bang-up year for Canadian corporate credit. We saw all-in yields close to 4% at year-end, a little higher at the beginning of the year. Investors really like the returns they are finally getting on credit, so there was a lot of demand. A lot of issuers came to market. We saw, I think, a little better than $150 billion in the Canadian market. That's probably going to be a record. Spreads tightened by about 15 basis points. There was a lot of geopolitical headlines, but they really did not dent demand very much after Liberation Day. And we're expecting that may moderate a little bit in 2026, especially in Canada, given that our economy looks to be slowing down a little bit. Most of the economic data has been not that strong lately.
Okay, so if we're looking at 2026, then on that point that you just mentioned, should Canadians be investing in Canadian credit this year? And if so, what should they be looking for?
Yes, we think they should. We like the spread on credit. We like Canadian corporate credit fundamentals, sales, earnings, cash flow, leverage, coverage. They're looking generally pretty solid right now. We're watching the Canadian consumer pretty carefully. The homeowners who have mortgages refinancing in 2026 are going to see higher rates on average. than they did when they financed or refinanced in 21 or the like. That may mean a little bit less spending at the mall, spending in the restaurants, spending on new cars. So we're a little cautious about anything that is consumer centric. We prefer broadly, we like the names that are very high quality. We like the names that are less consumer focused. We like to invest in sectors that, frankly, we cannot get a lot of in Canada. So we're looking at, for example, aerospace and defense, healthcare, IT. We tend to prefer to go to the larger, more liquid US market for those. And when we're in Canada, we prefer the larger, more liquid issues. We prefer pipes, best quality banks, insurance, some REITs. We also like some high yield names, especially the upgrade candidates, what is referred to as a rising star candidate, but we will tend to prefer to buy those in US dollars. That market is just a lot more liquid. We've seen a lot of new high yield names come to Canada in 2025, but those are very frequently first time or very rare issues.
Okay.
And they may not be so easy to trade out of in a market disruption. And we think there's enough geopolitical risk that is a thing. We want to use that as an opportunity.
Okay, so I'm glad you're mentioning geopolitical risks, because that's the kind of the next question I wanted to pick up on. You mentioned what we saw geopolitically in 2025 didn't have too much of a negative effect. But when it comes to geopolitical risks in the new year, what are you watching for the most?
Well, there's a laundry list.
Yes.
But the most important, I think, from the Canadian perspective is probably USMCA negotiations, which start this summer. That'll take a long time to play out, but the headlines could be enough to generate some wobbles in the credit market. And what I think you want to do, what we want to do as investors, as portfolio managers, is set up to take advantage of those, because that's really where the outperformance opportunity is in a fairly serious way. So that's why we focus on having a good bit of our portfolio in highly liquid, very high quality names that we can trade out of quickly in order to take advantage of things that are being sold off in a baby and bathwater kind of scenario.
And just lastly, in our last minute, how else would you recommend that investors kind of set themselves up for success in 2026? Like, you went through kind of the things you're watching for and things to look out for, but is there any other tips you have?
Active, active, active. This is going to be a year for bond pickers rather than index funds. It's not desperately expensive to invest in an active fund relative to a passive fund right now. And that's where you're going to get your protection. And it's also where you're going to get your upside, I think.
Okay, some good tips there. Adrienne Young, Portfolio Manager and Director of Credit Research at Franklin Templeton Canada. Thanks so much for joining us today.
Thank you, Lindsay.
Coming up, we've got John Zechner's outlook for markets in 2026. That's next. Stay with us. It's a brand new year, which means brand new possibilities for markets, especially around interest rates. And for his take, we spoke with John Zechner, Chairman and founder of J. Zechner Associates.
Rates are becoming I think, a tougher call. It's really a sort of a ball up in the air right now. It could go both ways, and I've been more inclined to sort of think we'd be hitting lower rates because we'd get some more economic weakness from the tariffs and other things. And we're not really seeing that. We're seeing a very resilient North American economy in general. I mean, Canada, because the trade agreements didn't, the tariffs didn't hurt us as much because things that were sort of compliant under USMCA it didn't apply to. So we've sort of come out of that. And in the U.S., the markets held up better. The consumers held up somewhat better, only at the high end. And obviously the AI spending has kept the economy strong. And on top of that, it's sort of pedal to the metal with fiscal policy in both countries. And that's sort of, offsetting any sort of any potential weakness out there. I mean, you look at it. I mean, it's the last three administrations in the U.S., quite honestly, the first Trump and then Biden and now Trump too, that they've, in peacetime, in non-recessionary times, you're running deficits of 6 to 7% GDP, which is unheard of. So you put all that together and I think, okay, you sort of got a more resilient economy. You got inflation sticky in this, 3% range. I mean, that last number is a bit of an anomaly and we're still getting, data because of the data restrictions flowing in. But, inflation really isn't breaking down to the levels where you should get more cuts in interest rates. Okay. And, no matter what Donald Trump may try to do with the Federal Reserve Board, I don't know that, he can sort of force them all across the board to get the 6 votes necessary to, push down rates as much as he necessarily wants to. So in the end, what I'm saying is, rates may not go in a lot of places right now, and they may not achieve the results. They may stay relatively high because of resilient economy, sticky inflation, and effectively the yield curve structure in the U.S. and the term premium to attract all this deficit financing.
So what does that mean? I mean, I've seen that they're talking. The guess is 2 rate cuts for the year, and they probably factored that in for the markets right now. What happens if we don't get those rate cuts? How do you see the markets responding?
Well, it's funny, Roger. I mean, nothing seems to disrupt markets to any large degree. You seem to have this buying momentum that just continues on because, the rate cuts didn't really come in as much as expected in the past year, in fact. But, I think at a point, given the high valuations, it's a bit of a risk. But on the other side, if the economy continues to tick along as it is, if you don't get any breakdown there, the fact that you're not cutting rates may not matter as much because it means the earnings will still be relatively resilient and in line, and but it'll just maybe shift away from some of the interest-sensitive sectors, utilities, to the degree that have done well, and even gold, and to more cyclicals. The industrials may keep going. The financials in this environment where you've got higher longer-term rates and maybe lower short-term rates have done better. So you might see more of that, just moving to the real economy, not just tech and not just interest-sensitives.
I know, but then today you look at tech and we see tech up, some of them are up 2% and 3% right now.
Well, they're having a nice bounce because they had we got no Santa Claus rally effectively in December, and so they stumbled a little into the year. And tech's had a bit of a tougher run lately compared to what they've had for the last, since the bottom in 2022. So, there's that aspect. But yeah, I would not bet against technology. Certainly at this point, it's an increasing part of the overall economy, and that's not going to slow down, particularly on AI. But I think it's just, where the valuations are extended, there's a little bit more risk. So we're careful where we're picking our spots there. And just the index weight in the U.S. and the passive money flows that worries me a little bit too. But in the end, like I say, it's a tougher call because the resilience of the economy and the stickiness of inflation may disappoint some investors in terms of what they get on cuts, and certainly the expectation for the housing market and others are for more interest rate cuts, and they're not going to get it. In fact, housing is a tougher call. I mean, problem is, even if you cut short-term rates, long-term rates aren't dropping, and long-term rates are what determine mortgage rates. So housing doesn't get the lift, and that's that's what the housing stocks are telling you. That's what lumber is telling you. That's what sort of Home Depot is telling you in their fourth quarter.
And just touching on, you mentioned inflation, 2.7. So there was some data that was missing from that. What do you think is realistic for inflation, and what kind of a role will it play?
I think core inflation is still running around the 3% level, Roger. Both, particularly in the U.S., where it's more important to see, what we're seeing right now in terms of the interest rate moves and then the central bank moves. Because you're right. I mean, there was some. I mean, you took out a core part of the housing index, or the imputed rentals factor, and they assumed it was zero, and they can't assume that's zero, and that's what you got to that 2.7 number. So we're going to have a lot of revisions for these numbers over the next couple of months, but like I say, it's an odd one. The employment number is an odd one, and no one's really hiring. I mean, you're not adding to the employment levels, but because of lower migration levels and everything, or immigration levels in the U.S., there's not a lot of firing as well, because people are a little worried about labor supply. So, it's a lot of things that may, in that environment, and that's what some of the Federal Reserve Board members are telling you. It's better just to sit tight and watch and to see how it unfolds.
Coming up, we get another money manager's outlook on U.S. and Canadian markets for 2026. That's next. Welcome back. It's time to look ahead on what we can expect for the U.S. and Canadian markets in 2026. And for more on that and what kind of outlook investors have, we were joined by Brianne Gardner, Senior Wealth Manager at Velocity Investment Partners at Raymond James.
The big question is really whether the U.S. or Canada leads. And our view is that we see the S&P 500 likely having a little bit of an edge, but with a few important caveats, I'd say. Most street forecasts right now, analysts are predicting the index climbing again this year. We're seeing some targets across the street as high as 7,500 to 8,000, driven by earnings and the tech sector leadership continuing to pull it higher. I think, base case, we do expect 8 to 10% from the S&P 500, right in line with its long-term kind of average return. Bull case, you see a bit of a melt up, and we see another double-digit year. I think the U.S. economy is entering 2026 still in really great shape, right? We've seen GDP and retail sales are still showing no signs of a slowdown yet, and commodities have had one of the best runs in decades, and we really think it will continue to be one of the leaders again this year. So that said, I still prefer a diversified portfolio that can generate, alpha by tactically positioning, so that if a sector volatility hits, and we do expect 2026 to be quite a volatile year, especially with midterms coming up, the portfolios that, will see a little bit less of a downside. So we are continuing to expand across different sectors and geographically as well.
And we've been spoiled the last 3 years, double-digit plus returns. Could that be a factor? People expecting something like that again? Could that play into it? Emotion?
Yeah, I think one thing that we're watching that's continuing to drive markets higher is really earnings, right? In the U.S., earnings are still doing the heavy lifting. The S&P 500 profit margins are expected to be near 14% again in 2026. So again, still double-digit growth out of a lot of these large cap companies, and that's well above long-term averages. And so when we're seeing that type of profit margins well above that, that keeps the earnings story intact. Revenue and earnings should see double-digit year over year. In Canada, the TSX can still do well, but leadership likely to shift, and the Canadian long-term returns are typically slightly lower than in the U.S., which is expected to continue to see that this year as well. There will be a few, I think, areas to make money. And while commodity prices will help the materials sector, demand for quality, income should support dividend payers and diversification rather than kind of chasing that rapid, growth story still. So I think volatility is, again, going to be something we expect more this year, a little bit more muted going through 2025. We only had that one double-digit correction mainly. So not a crisis level volatility, but I do think more frequent rotations between sectors, style, and regions. And as a market reacts to these earnings, that numbers that are coming out, interest rates, continuing to come down, and trade-related influences on corporate America. Again, I think that we will see a strong year through 2026, but could be a little bit challenging to start.
All right, John, you want to jump in?
Yeah. Hey, Brianne, Happy New Year. You got to get, we have quite a winter up here. You got to get up here, get on the hills with us.
Hi, John. Happy New Year to you.
Roger and I were chatting a lot about the tech stocks already, and I'm sort of curious, where are you playing? I mean, everybody's sort of in tech, but I think the big thing is, what parts of it. So what are you looking at both here and in the U.S. and within the tech sector?
Yeah, I think from a sector perspective, we did see tech, continuously lead 2025 and have a strong, earnings and returns for this past year. But I don't think it's going to be the tech sector alone that is going to continue to carry the markets. With, historically, the tech sector, it does tend to be one of the strongest ones. And there's usually more help from communications, industrials, consumer discretionary, so to say. In Canada, 70% of the performance of the TSX came solely by materials and financials. And those two will likely continue to be kind of the top half again. So yes, I still think earnings are projected to be in the tech sector double-digit growth. And can these large cap names continue to do well? I think, again, the AI story, if we're specifically going in there, I think it's going to be a little bit more broadening out as we're getting more companies who are getting into the space, developing more, and not just on the chip story, but more on, how is this going to be sustainable in the long run, and what sectors are going to continue to benefit from that. So that's certainly all things that we are looking at in the tech space. And I think, with that in mind, we still like U.S. tech names given corporate investments and productivity gains. Utilities, especially tied to rising power demand, is going to be a big one. And I think, too, healthcare, has been an underlying story where valuations are attractive and earnings have still remained resilient in that space. Okay. So I do think we're going to start seeing utilities kind of pick up there, too.
That was Brianne Gardner, Senior Wealth Manager at Velocity Investment Partners. Raymond James. Coming up, the new Free Trade and Labor Mobility in Canada Act will come into place this year. We've got more on what that means right after the break. The price of aluminum climbed above $3,000 US a ton for the first time in more than 3 years. That jump is due to a cap on Chinese smelting capacity, as well as constraints to European production due to higher electricity prices. Both have chipped away at global inventories, and the demand outlook from the construction and renewable sectors are also contributing factors today. Shares of Tesla remain under pressure. The EV maker had reported a bigger than expected drop in fourth quarter deliveries and also posted a second straight decline in annual sales. Sales fell nearly 9% compared to the year before, while deliveries fell 16%, missing Wall Street estimates. Tesla has been struggling to boost demand for its vehicles after the withdrawal of tax incentives. Investors are also noting concern about the automaker's 2026 sales targets. And shares of Sable Offshore Corporation are surging today. The company has received the go-ahead to restart a contested pipeline. A federal court has ruled Sable can now begin pumping oil from its 3 platforms off the coast of Santa Barbara, California. The ruling is the latest win for the oil operation, which has been battered with lawsuits and regulatory scrutiny ever since ExxonMobil handed over the reins after the unit was shut down following a massive oil spill. Take a look at the markets today. The TSX was boosted earlier. It's down a little bit at the moment. Energy stocks seem to be fueling the TSX today on this first day of trading in 2026. If we take a look at the U.S. markets, relatively flat, not much movement from the S&P 500, down by 0.1%. Dow Jones is up by 0.1%, and the Nasdaq Composite down by 0.2%. The new Free Trade and Labor Mobility in Canada Act will come into place this year, changing how provinces exchange goods. CTV's Jeremy Chiron has more on this report.
It's a promise the Prime Minister made often in 2025.
So we're building one Canadian economy.
a pledge to remove barriers to interprovincial trade announced last year that today came into effect. Bill C-5, the Free Trade and Labour Mobility in Canada Act, now means provincial requirements for goods and services and workers' licenses will be recognized federally too.
I think symbolically, it's a really good way to start off the year. Actual impact, I think it's really more the provinces than the feds that we're looking for action from.
A separate mutual recognition agreement signed by all provinces and the feds is set to be implemented by June. It will further impact interprovincial trade, but still, experts say some key goods are excluded and still face challenges.
Alcohol, right? Beer, wine, spirits is one example, right, that we hear a lot about. And so there are still ongoing conversations at the provincial level to make it easier to move those goods across borders.
While 2025 saw governments across the board push to trade more within the country, several bilateral agreements were signed between provinces. Experts say 2026 needs to be about follow-through.
There needs to be tangible action on the ground this year, and it needs to come quickly because the CUSMA threat is hanging over all of us.
On the international front, the stakes couldn't be higher. Canada's free trade agreement with the U.S. and Mexico is up for review this year, only putting more pressure on bolstering the domestic economy.
I think it's fundamental to our ability to respond to the threat from the United States, from the tariffs, which probably aren't going to go away soon, even though we have the possibility of a review of the CUSMA.
Formal talks are set to get underway in the coming weeks ahead of a July deadline, when a decision will have to be made on whether to extend the deal as is, negotiate a new one, or either country could decide to walk away.
So what can we expect for the U.S. and Canadian markets in 2026? We were joined earlier with Michael DeHall, Senior Portfolio Manager at DeHall Investment Partners, Raymond James.
Some of the policies that they're putting into place could provide some tailwinds to our Canadian economy and to our Canadian equity market. Areas that we do like are industrials, as well as other types of financials sectors within the Canadian economy. But we do think that the Carney government will have some great policies in place, more of the physical side. The heavy lifting has been done by the Bank of Canada, so we do not expect any changes to interest rates in 2026 in terms of rate cuts, but we do think that now the fiscal policy should do its job.
And start to kick in. What else would you like to see from the Carney government?
Continued spending, more spending on infrastructure, on construction, to really beef up our economy here in Canada, as well as trade partnerships outside of the U.S. I know Carney has been going to other parts of the world, Middle East, Europe, Asia, to strengthen those relationships. So what I'd like to see in 2026 and beyond are more partnerships with other countries outside of the U.S. and really strengthen those relationships and helping our exports go across borders.
Now, I think a lot of people were expecting these magical deals to be signed all in the first 3 months after he made these announcements that we're looking outside the U.S. What kind of possible headwinds might we see for the Canadian economy?
The big headwind is obviously the U.S.-Canadian trade relationship, right? We do have the USMCA agreement coming due, I believe it's August of 2026. So we could see some volatility ahead of those talks, and if anything, if there is any agreements prior to that date, but that could be a headwind. Another headwind to our Canadian economy could be a job market. We are seeing a bit fragility in our job market, although the last 3 months, the unemployment rate has come down slightly better than expected, primarily due to part-time jobs. But the job market is something that we are looking at, whether unemployment rate goes higher and the impact on immigration. Obviously, the government has reduced the number of immigrants to Canada, and that could have an impact to our economy as well.
And it does seem like a lot of companies have adjusted or adapted to the tariffs, and they didn't have as much of an impact. But of course, if CUSMA goes by the wayside, as Trump has hinted that could happen, that would have a huge impact, though, wouldn't it?
Absolutely. And that's the big the question mark is the uncertainty around the trade talks, right? So if that does go a bit sour, that could have a headwind to our economy, and so that's something that we are definitely looking out for. But we do think that our government, Carney, and the party will have our best interest for the Canadian consumers to kind of alleviate any negative impacts to those discussions or to that agreement that could come forth.
Okay, let's talk a little bit about the U.S. economy. What are you seeing? Unemployment was down there as well. It seems to have defied expectations, hasn't it?
Absolutely. We had such a resilient U.S. economy in 2025. After the Liberation Day of April, many people thought that the U.S. economy was going to go and, derail. And however, the consumer, the U.S. consumer, once again proved resilient. And GDP growth in the U.S., I believe, will probably come for the full year higher than expected. And we do think that that continues. We think that the U.S. resiliency continues in 2026. This year, we'll probably see more tailwinds on the AI front. We're looking at companies that are benefiting from AI, from productivity, from efficiencies on adopting AI. So we do think that, in 26, U.S. economy continues to march higher, obviously at a slower pace for the last 2 years. But we do think that we will probably get another robust year in the U.S. Economy, and we'll probably get another good year in the U.S. markets. We'll probably get more volatility this year than we had last year, but with some of the, the tax cuts that the Trump administration is implementing, deregulation, as well as the Fed continues to ease throughout the year in 2026, that can all provide very fruitful for the U.S. stock market.
And you mentioned about AI and companies are starting to incorporate it now. Are we starting to see actual figures on savings and or potential savings with it?
Yeah, we're still in early days. A lot of CFOs, CEOs on the earnings reports, they are earning calls, are looking at AI, how they're adopting it, how they're increasing their margins, improving their gross margins using AI. So we are still early days of AI adoption for the beneficiaries, but we do think over the next several quarters, it will get better as more and more companies adopt AI in terms of improving efficiencies. And again, that would go right to the bottom line, improving gross margins, which in turn helps stock prices.
Okay, I just want to bring it back to Canada for a sec. Mortgages for 2026. It's always something everybody's talking about. The housing industry, the housing market for Canadians is a big deal. What are you seeing there?
So that is a potential headwind. We do have a number of mortgages that are renewing in 2026. Remember, these are the so-called COVID mortgages that people got 5 years ago, right? So that would be something that we are looking at during the last the big Canadian bank earnings season that we had last month. Banks are increasing their PCLs, putting some money aside for potential loan loss provisions if consumers are unable to renew their mortgages or have difficulties with their mortgages with a higher rate. But that's something that we are definitely looking at. It is a topic of concern in 2026, the housing market.
That was Michael DeHall, Senior Portfolio Manager of DeHall Investment Partners at Raymond James. Coming up, tech stocks like NVIDIA are rallying today, but is there reason for caution? We'll get insight from one veteran investor right after the break. Tech stocks soared in 2025 on AI hype, but cracks are starting to show. From NVIDIA's dominance to Oracle's warning signs, we are forced to ask ourselves, is the AI trade entering a new phase? For more on that, we spoke with John Zechner, chairman and founder of J. Zechner Associates.
If NVIDIA is the coal mine of artificial intelligence, is Oracle the canary in it? And that's sort of what I want, because that's really been the whistleblower on some of the valuations and the stories in the past quarter in particular. It's almost like we're talking about an interest rates as well, Roger. I mean, there's a lot at stake here, and it sort of could go either way. We know technology will continue to grow. We know it's an increasing part of the economy. AI will ultimately, is going to change productivity and improve the economy. Apparently massively, and we've seen all the indications from that. My issue is a little bit you're paying for so much of it today, and anytime you pay for something that has not happened yet, at an accelerated rate or a higher rate, you have inflated risk effectively, because if it happens, well, it's happened and we were paying for it already, so it doesn't go much higher. If it doesn't happen, there's a lot of downside to it. And that's why I get a little queasy about, the valuations and just the bullishness around the story. And like I say, people say it's not the same as 2000 because they're better companies, they're more resilient and all of that. Absolutely true. But I'm starting to see a few things that remind me a little of 2000-ish. I mean, the one is this Oracle's, what kept Oracle going. Like I say, that's why the canary in the coal mine really started lifting in September to those massive gains was, they are becoming the sort of the AI cloud in their data centers. And that's sort of and they had sort of great contracts from OpenAI, but they're not really revenue contracts. They're not backlog. They're what they call RPOs, or remaining performance obligations, which is a sort of an indication or almost a promise that at some point we will generate these revenues. And they're sort of you can't put them on the balance sheet, but they're putting them in the financial statements and the releases. And that's what's driving a lot of the growth. And, that reminds me a little of, remember back in 2000, this is the eyeballs test and things like that. I thought you need something real. I mean, the combined spending of the Mag 7 last year, or the hyperscalers, with basically $400 billion on AI infrastructure and AI rollout. You start doing it over multiple years, you've got trillions of dollars invested. To get any sort of normalized return on equity or return on investment on this amount, you need hundreds of billions of dollars worth of improvements in productivity. And, maybe it'll come. And I listen to both sides of the arguments. Roger, I haven't seen it yet. A little from Missouri, a little of a skeptical on that. Like, I started my business in the 90s, the early 90s, and it was the age of the internet. And at that point, I mean, it had a massive impact on how, how you do spreadsheets. You started networking. You could sort of relate that within your client base, within, who you could talk to. And then there was a huge improvement in efficiency. I mean, ChatGPT and Gemini, I find them, interesting, and I use them, but I have yet to see that massive productivity increase. And others tell me, no, it's coming and it's going to be huge. But we're paying for it already.
What might be some triggers for you in 2026 that would really have you thinking?
Well, I just think maybe a slowdown by some of the hyperscalers in their spending might indicate that maybe demand isn't exactly where they expected it to be, or not a continual increase in that. That would be a bit of a headwind. But for the technology sector, general, Roger, my way to play is, why don't we play the stuff that is assuming the negative impact of AI? And, it's gotten overly beaten up. I mean, the software companies, everyone assumes that AI is going to bypass the need for application software. I don't think companies are going to restructure, their entire back rooms and their entire application systems and everything else, on a whim or immediately. And yet these stocks are sort of being priced. You'll get, Salesforce and Adobe and Workday and ServiceNow and all of this. They've been, stocks have been, put under a lot of pressure. Look at Constellation Software up here. I mean, I'd rather kick the tires on those at lower valuations than to chase some of the, the high flyers like the Oracles and the Palantirs of the world that are really, I think, have all the optimism of AI built into them already.
But isn't there dangers, though, with looking at the ones you're looking at, that if AI does come true, they actually will be obsolete almost?
Absolutely, but it's almost a counter of the argument that I use I hate paying up for something that hasn't happened yet on the expectation that it will. On the same thing, when stocks get punished for a negative outcome that may or may not happen. Well, what's your downside if it happens the way we're expecting? Well, the stock's already trading at, look at Adobe trading at, 15 times forward earnings. I mean, there's probably not that much downside risk from that. So, I'd rather, but that's more more of a value orientation in that regard. So that's what I tend to do is, look for some of the laggards where there's too much pessimism about, the negative impact of AI on these companies. But, on the other side, there's the, healthcare will be a beneficiary, telecom will be a beneficiary. We see lots of it. I just want to see more concrete examples of it. And I think the market may get impatient at a point that, there's a lot of talk, but let's deliver something.
Still ahead, we've got a look at some of today's market movers, including Tesla. That's right after the break. Welcome back. We're going to take a look at some of the big market movers today. And for more on that, we're joined by Bloomberg's Natalia Kinichevich. It's good to see you, Natalia. Happy New Year. We're going to start with Tesla. Tesla price targets have been lowered. The stock price continues to go down. What's going on?
Hi, Happy New Year as well. So yes, Tesla shares are down today after the company reported sales of its vehicles. So sales fell at 8.6% last year and 16% last quarter. So by contrast, Chinese competitors, like BYD, posted an increase in sales. So it was expected. The company, Tesla, also posted a survey of what analysts expected in terms of sales decline. So the number was 15% decline, but then what we got today is actually even worse than what Tesla expected. Now, many analysts are now looking at other segments, of course, autonomous vehicles, robotics, as well as even power distribution. So we know that Tesla deployed 14.2 gigawatts of hours of products last quarter, and that was a big spike, almost a 30% gain on a year-over-year basis. And some analysts are saying that a few years ago, that segment didn't matter that much, but now it represents almost mid-teens percentage of sales. So it is becoming more important.
Very interesting. You're also watching RH and Wayfair today. Those shares getting a boost after Donald Trump announced that some of those expected tariffs are going to be delayed by another year. What's happening there?
Yeah, so President Trump decided to delay and increase tariffs for upholstered furniture, some kitchen cabinets, as well as vanities for one more year. He cited ongoing trade talks as well as some uncertainty and cost of living concerns. So the current tariff, which is 25% and which was imposed in September, is still in place. And of course, we are watching how these furniture companies are navigating this uncertainty and elevated costs. And the picture actually shows this so-called K-shaped recovery for U.S. consumers. So, for example, RH, this is more from a company operating in the luxury segment. This stock declined by more than 50% last year. And by contrast, Wayfair gained by about 120%. The company posted better than expected earnings last quarter, and they also boosted outlook for sales. So companies are kind of moving into different directions.
And lastly, Baidu, those shares have jumped 9% in Hong Kong trading. Tell us a little bit more for those who maybe don't know what this company is and what's going on, what's with the spike today.
Yes, absolutely. So it is a Chinese company, and today it actually also filed the official proposal for listing of its artificial intelligence chip unit. It's called Kanlanshin. So this Kanlanshin unit, it produces chips that power, of course, data centers. We don't know the size of the deal, the structure. It still hasn't been determined, but many analysts got really excited about this development. So, for example, Jefferies analysts are saying that Kanlanshin valuation could be between $16 to $23 billion. So that could be a pretty sizable IPO. And then also Jefferies raised Baidu price target by around 14%. So this is just another confirmation that the IPO market can be exciting in 2026, not just in the US, but in China as well. So we'll keep an eye on those developments.
Yeah, lots to keep an eye on as we start off a whole brand new year. That's Bloomberg's Natalia Kinichevich joining us live. Thanks so much. And before we go, we will take one last quick look at the market, starting with the TSX today. It's relatively flat. If we take a look at some of the charts here, you can see not much trading happening today. That's kind of the story across the board. U.S. markets basically flat as well, just very, very small changes. We've seen weakness in big tech sector today, starting off the new year, and that's been affecting the U.S. markets, including the S&P 500, which is down at the moment. Dow Jones is up ever so slightly, and the NASDAQ composite also down. If we take a deeper dive into some particular movers, mostly on the TSX today, that's what we're watching for. Denison Mines is one of the top gainers on the TSX. It's up almost more than 14%. on the TSX today after announcing it was going to begin construction on a uranium mine in Phoenix. We're watching that story pretty closely today. You can see it's up just over 14% at the moment. Energy Fuels also up more than 14%. That stock been trading higher over the last few days due to higher uranium sales. Gold and silver stocks also taking a bit of a hit today as well. IM Gold and Lundin Gold on the TSX are down. And that wraps up this edition of Trading Day. Thanks so much for watching.